Hi guys, and welcome to my YouTube channel. In today's video, I'm talking about something that I'm very passionate about, which is the tax-free savings account. I strongly believe that we should all have a tax-free savings account, whether you are a beginner starting your investment journey or you are someone who is in the process of building wealth. I believe that a tax-free savings account is an investment hack that we should all consider. And I'm going to give you some of the reasons why you want to look into a tax-free savings account as a pillar of building wealth, as someone who is in a journey of financial freedom. Okay, I'm looking for my lip. It's an ad break. Someone needs to buy me some lip. Okay. Thank you for waiting it out. So a tax-free savings account, it is an investment account. In as much as it is called a savings account, that is a little bit misleading because it is an investment account. Why the emphasis on investment account is that because it works out perfectly when it is a long-term investment vehicle, unlike using it for a savings purposes. I don't know whoever named it savings, what they had in mind. However, as I elaborate on what it is and how it works and how you can best use it to your advantage, you need to keep that in mind, that this is an investment account. Okay, so a tax-free savings account was introduced to South Africa in 2015 to actually encourage South Africans to save. So we are considered as a country that has lowest saving rate per household, and that simply means that in a household there is very little of the money that's coming in that's going towards savings. So the government decided that they will give us a tax-free savings account just to encourage us to save. And the reason why this is important is because the tax-free savings account allows us an exemption of investing without us being taxed on our investment. So the returns that you make within your investment on a tax-free savings account does not get taxed. Therefore, it's encouraging for someone to want to invest because they know that the money that they will put in plus the returns, it is all theirs. Okay, so the reason why I was also emphasizing that it started in 2015 is just to encourage you that you are not late. Sometimes there is a thinking that, well, everyone is always talking about tax-free savings account. Can I even start? Am I too late? You are actually not late. Okay, so you're not late because it only started in 2015. It will only be 10 years old now in 2025. So it's a very small investment product and you still need to tap into it and actually get the benefit. One of the things that I can tell you is that although people are aware of what a tax-free savings account is and how it can benefit them, what I can tell you is that we are nowhere close to maximizing the potential that is within the investment account, the tax-free savings account. Okay, so we still need more people to start maximizing on that savings account, and we still need more people to start tapping into it with an understanding of what it can do for them. Okay, so I hope at the end of this video you have an awareness of how it works, how it can benefit you, and how you can start and how you can incorporate it in your wealth building journey, or how you can incorporate it into your financial independence journey. Okay, so I did mention that it is a tax-free, so that means that the investment that you make on your fixed deposit account, which is interest, does not get taxed. The investment that you could the returns that you could make on your shares, which is capital gains and dividends, does not get taxed. So on a normal day to day, if you invest on a banking platform or fixed deposit account and you make money returns, interest in that account, you would be taxed at least, you would be exempted for only 23,800, and all the other returns that you make outside of the 23,800 then become taxed. This seems like 23,800 is a lot of money. However, in a long run, when you have gotten enough money that can get you more than 23,800, it will be sad to have some of it being given to SARS. So the beauty about the tax-free savings account is that all that money, the returns that you make, it is all yours. and SARS does not get to take a single cent from it. Okay, so when you start making a little bit more money, then that is where you start realizing the importance of a tax-free savings account. And that's why I said it's a long-term investment vehicle that you can tap into, because you get to realize the benefits when your money have accumulated to a little bit more. Okay, so similarly to dividends and capital gains, you have exemption for dividends for for capital gains, which is 40,000 rand. But if you start making more than 40,000 rand per annum, then you start getting taxed. You will get to such point if you're consistent in your investment journey where you can make more than 40,000 per annum, and this is where the importance of a tax-free savings account start kicking in, right? And for dividends, we have a flat tax rate of 20% in South Africa, and if you invest on a tax-free savings account, that also does not apply to you. So all the dividends that you will be getting, that dividends notification is so nice and exciting, all of it then becomes yours if you're investing on a tax-free savings account. So this is what makes the tax-free savings account a little bit more exciting. So some of the people actually ask, like, why is the tax-free savings account and not being taxed so important? It is important because the money that you make on a tax-free savings account makes a returns. It could be dividends, capital gains, or interest. All those interest that you make makes more interest through compound interest, and all that return becomes yours. So if you know the concept of a compound interest is that the returns that you make starts to grow more and more and more and make more money. So this is what actually makes you to have more money, because all those returns then become yours without you having to pay more tax. So I have noticed that in South Africa, more people start having 1 million, 2 million in their accounts only when they retire. And it's simply because within the structure of a retirement fund, provident fund, and pension fund, there is a long-term investment concept that has been incorporated there, which means that it's made difficult for you to withdraw. A lot of people don't withdraw, hence their money gets enough chance to grow. Their returns that they are making ever since they've started working, those interest they made initially grow to become more money. And this is the same concept that you can apply on your tax-free savings account, where you allow your money to grow in there without you withdrawing. And the small return you make in the beginning continuously make more babies, more babies, more babies, and they will accumulate into 1 million. And I will demonstrate what that looks like as an example of a tax-free savings account later, right? So the compound interest concept then applies as well on a tax-free savings account if you're consistent in your contribution, and also if you start early and let your money grow more babies. Okay, so hence we get to see that million or millions when we retire. It's because we allow our money to grow. So I am encouraging you to use the same mindset that you use in your retirement, same way as you apply the same way, apply the same rules on your tax-free savings account, and that's where you will see the return. So it's very important to indicate that on a tax-free savings account, we can only contribute 36,000 per annum, right? This is the maximum that we can contribute in a year, and in a lifetime it's 500,000. So why is this important? If you contribute more than 36,000 per annum, SARS will actually penalize you, and the penalty is actually 40% of your contribution. For an example, if you contribute 40,000 instead of 36, right, the 4,000, which is a top up from your 36,000, will then get taxed, and it will get taxed at 40%, and 40% of 4,000 is 1,600. So you will just be losing 1,600 for nothing. So just try to make sure that you comply to the rules and you don't exceed 36,000. What I like is that a lot of funds these days actually have a place where you can see how much you are left to contribute, so that you don't accidentally over contribute without being aware. So that's something that you should be aware of. And if you're contributing on a monthly basis, you will have to put in at least 3,000 rand per month, so that at the end of a tax year you have contributed 36,000, because that will be 36 times 12, which is 3,000 times 12, which is then 36,000. And another factor which is important to note in regards to the maximum is that the tax year starts from March, the beginning of March, towards the end of February of the following year. So that is our South African tax year. So don't be confused and use our financial year, our normal year, fiscal year, as a tax year. It doesn't work like that, right? So a lot of people actually ask me, Sonda, where do you think I can get this 3,000 per month or 36,000 to maximize my account? You know, to be honest, no one has surplus. You have to just make a way. It's either you can live below your means and try to prioritize maximizing your tax-free savings account through your month-to-month income and take out 3,000 rand per month to ensure that you contribute and you maximize. Another way is to contribute less on a month-to-month, and when you get your bonus, you can use whatever it is that is remaining from your bonus, right? So you can use a strategy of maybe you can put 1,500 per month and towards your, and at the end of your, when you get your bonus 13th check or performance bonus, then you take whatever amount that is left for you to maximize your account and you use your bonus money. So there is not necessarily a place where I'm assuming you will find money which is idling. I'm actually expecting you to be sacrificing from somewhere, to be sacrificing for some places and reallocate this money to this. And I want you to also understand why it is important to actually prioritize this account over many other accounts that may exist. Of course, if you don't have an emergency fund, prioritize emergencies, because what normally happens is that if you start investing without having an emergency fund, then what will happen is you will desire to withdraw from your investments so that you can cover your emergency. Sometimes what would happen is that you will then go and ask the banks to offer you personal loan or credit card so that you can cover your emergency. And what is the use of you having a credit card and a personal loan when you have an investment, right? So it's very important that in the same thought, when I say prioritize tax-free savings account over any other investments account, I'm not saying that do it over building an emergency fund or do it over paying off of a credit card. But if you are to invest, this is the first place of priority to consider doing your investment on, because at some point you will have a huge lump sum of money that will all be yours without SARS taking a single cent. Okay, so consider starting with your tax-free savings account, with your emergency fund, just so you don't jeopardize your journey and be behind, right? And at the same time, if you don't have enough money, you can't cut off, you also cannot cut out somewhere, you cannot save, it's just impossible. Consider getting an extra source of income, guys. Like, there's just multiple ways in which someone can make money, and then consider making extra from somewhere so that you can be able to maximize your tax-free savings account. However, if you can't maximize it, it doesn't mean that you should not use a tax-free savings account. A tax-free savings account can allow you to also contribute. If you're contributing 500 rand, if you're contributing 1,000 rand, if you're contributing 2,000 rand, it's not mandatory for you to maximize it. The concept of maximizing it, I just love it because you get your benefit very fast and very quick, right? Because the beauty about compound interest is that it maximizes on your time. So the more time your money spends in that account, the better it can reproduce itself, right? The better it can compound itself. Sorry about that. So as long as you contribute, then that's good, and if you don't exceed the limit that is there, then it is good. So in terms of numbers, the benefits of a tax-free savings account in terms of numbers, I thought I was gonna do this on a separate video, but let me just include it here. I can do a separate video talking about the numbers in terms of tax-free savings account, because for me, this is where you get to realize that, damn it, this thing is powerful, right? So I want to play around with numbers here so that you can see what we are talking about, right? So this is me, my personal example. So for someone who wants to contribute, maximize their tax-free savings account, for them to get the lifetime contribution, it's when they have contributed that 36,000 for 14 years, and they will be able to reach that 500,000 maximum contribution. Then they will stop contributing, and their money still grows, make interest. With the growth they're making, they will still not get taxed, but as soon as your contribution reaches 500,000, you will then have to stop the contribution, but your money will continuously grow inside that account without you contributing anything. So for me, 2025 will be my 6th year of a tax-free savings account, right? Like I said, this is a very young account, so you're not very late. You can also start. This is my 6th year, so that means I will be left with 8 years from 2025 And that means that I will maximize my tax-free savings account in 2033, right? So in 2033, considering the return on investment or interest of 11%, which is what my current tax-free savings account is getting annualized, I will have 1.1 million, right? 1.1 million in 2033, and 500,000 will be my contribution, and that will be the year in which I stop contributing, and 642,000 will be the growth. So I will have more interest or more growth in that account than I would have my contribution. So in this year where I will reach my maximum contribution of 500,000, then my contribution will be less than the growth that I would have accumulated over the years. And that's the beauty of the account, because the longer you let your money grow into that account, the more it gets to make more babies, and then your contribution just becomes smaller and smaller while your growth becomes more higher and higher. It continuously grow, right? So this is where I actually feel like you get to realize that you know, the longer you make your money, the longer you start, the better. And this is how you kind of allow time and compound interest to play on your behalf. Normally I get people asking me that, okay, Zwanda, how do I make a dividends paying strategy? For me, I feel like the tax-free savings account investment strategy is actually the best way in which you can get dividends paying strategy. Why do I say that? I say this because if you keep that money, that million in that account for 10 more years in that account, it possibly going to be 3.2 million, right? So you're going to have 3.2 million. However, if you and the reason why I'm giving you this example is just to give you like a taste of, if the money stays in that account, what would it look like, right? And it's huge. It's really big. And imagine if you're doing that for your child, like if it's a tax-free savings account that you've opened for your child, and then at the age of 14, from the age of 1, you start contributing for them that 36,000 per year, and then when they're 14, you have contributed the maximum, and they have that 1.2 million, and you put it in that account for 10 more years, and when they're 24, they have 3.2 million. Guys, like, that's like really powerful money. If my parents would have given me even the 1.2, I would have been just super grateful. Even half of it, which is 500,000, I would have been grateful. Meaning that as a parent, you don't necessarily have to be obsessed with maximizing it. Even if you do half, even if you do just 1,000, you realize that at the time in which the child gets to 14 years, you have half the money, which is 600,000, and that's like really also good amount, right? And yeah, you get to give your child like a good start, like a financial head start, and that's something that we all wish our parents would have done for us. So going back into the dividends paying strategy, right? So if you keep that money just one more year, you won't be contributing, but you keep it in that account without you taking anything. That 1.2 at 11%, it's probably going to be like 120 something thousand, and divide that by 12 is 10,000 per month. And this is how you get to start withdrawing from your investment without the money within your investment decreasing. That's really some powerful stuff. Okay, so also people will ask you, can I withdraw from this account? Yes, you can withdraw, but is it recommendable? Not really. You should not be withdrawing, right? Because like I'm saying, the more you keep that money into the account, the more you realize the growth. But also, looking into that lifetime contribution of 500,000, if you withdraw, let's say for an example, at some point you start contributing maybe 3 years, and you have 90 something thousand, or you have 2,000, because you've contributed for 3 years, and then somehow there's an emergency, you withdraw that 100,000. That means that you have reduced your maximum limit now to 400,000. That means if you are to restart that journey again, you will only contribute 300,000 because 400,000, because you would have withdrawn the 100,000. So any amount that you withdraw, you are withdrawing from your lifetime contribution, and that means that if you can only contribute 400,000 versus 500,000, your money will only compound for 400,000. And it's like the more maximum money you can have there, the more you're allowing more money to compound, right? So you're kind of withdrawing or stealing from the highest potential you could be getting, because the more money you have in that account, you know, the more you get the benefit, because it's more money growing, compounding, and more money that is not getting taxed. So that's the beauty about the tax-free savings account, right? So again, it is meant for a long term. It is meant for a long term, and if you are considering to withdraw, maybe this account is not the right investment vehicle for the purpose in which you're intending for. Maybe if you want to withdraw, look for a high yield savings account where you can still get some interest, but at the same time you can still withdraw, right? If you're depositing on a tax-free savings account, even if it's small, there's 500 rand, 1000 rand per month, just also know that you're doing it for a long time, 5 years, 10 years, and 15 years, so that you can see the real potential that lies in this account. Having more money that is attracting tax, but yet you're not paying tax. That's the benefit of a tax-free savings account, okay? So that's the things that you need to keep in mind. I'm about to finish because I don't want this to be too long, because really I have I'm already, yeah, but it shows my passion, right? So other people also ask, like, can I open multiple accounts on a tax-free savings account? Yes, you can, but is it advisable? Not really. You should not be doing that, because why are you opening multiple accounts? The reality is consolidated. All your tax-free savings account will be consolidated. The total of consolidated accounts contributions should be 36,000. So why would you open one here, one there, when the maximum, regardless of where you open it, is 36,000? So this is monitored by SARS, so you cannot necessarily cheat your way into it. You are eligible for 36,000 per person, 500,000 per person. So going back into the child, contributing for your child, also just be mindful that, you know, you don't steal your child's contribution for your own benefit, because one person has one chance of a tax-free savings account. So if you're doing it for them, just make sure that it is for their benefit, and you can, you know, somehow gift it to them at some point in their lives, okay? And also, a tax-free savings account is a shell, guys. This account still needs you to buy some asset in it, whether it's commodity, whether it's commodity, equity, bonds, or cash. Whatever asset, you need to still buy those inside your tax-free savings account. I've heard some of my clients saying I've been depositing money into my tax-free savings account, but it's not growing. You still need to buy either a financial product, either unit trust, ETF, whatever it is that it is eligible for a tax-free savings account. In your tax-free savings account, you still need to buy it so that you can get to see your growth. And also, if you're looking into buying ETFs, guys, please stick to less than 5 ETFs, because there is such a thing called over diversifying, where you're losing 10% here and you're gaining 5% here, and then it's just averaging out to a negative. So just try by all means to maximize it, to just maximize on the top 5 ETFs that you can choose. And I will do a video reviewing my own portfolio on a tax-free savings account, just so you're aware of what I mean when I say over diversification, because I want to sell some of my ETFs on a video so that you guys can see what I'm talking about when I say over diversification, you know. And just also to understand that just having many ETFs doesn't necessarily mean that your portfolio is diversified. You could be over diversified, okay? Yeah, I still have some more points, but I'm just going to leave it here for now. And if you have many questions or some questions that you want to ask on a tax-free savings account, let me know. I am going to talk about a lot of ETFs video. I'm going to talk about ETFs a lot in the next coming videos. So if you have watched until here and you're looking forward to me speaking about ETFs and how to choose the ETFs and how to strategize your growth within ETF space, then just give me a white heart. Let's surprise those who didn't watch until the end and show them that we are committed. Bye bye, guys, and all the best.